But a lot of the strategies that the FIRE movement uses, financially independent, retire early individuals, they would have. Hello everybody, this is Ronan Blue, just taking my daily walk here today. And today's topic would be on how to live off investment income. So for investment income, you need to ask yourself on reasons why you want it. So would it be to just pay your bills? Or would it be just to generate a lot more cash? Or would it be towards maybe retiring one day? So there's a whole bunch of different questions you need to ask yourself. So the best kind of investment income would be a collection or a combination of your stocks, bonds, mutual funds, ETFs, and also real estate, and getting the highest possible returns with the lowest amount of risk. So basically how it works is an investor gets some passive income or residual income dependent on the asset on a monthly basis, so they can cover their daily costs. So you can have enough funds coming in on a monthly basis to be able to pay for your mortgage or go on vacations if you wanted to, or anything that you enjoy. So for this to work, you have to really figure out how much you'll be spending on an annual basis. But the hard part for this is that there's no one set number. Everyone's very much different because everyone's cost of living is different. So maybe you're thinking of a nest egg of $1 million as an example. And with that $1 million, maybe it's possible for you to generate $60,000 per year. So roughly about a 4% to 6% withdrawal rate on an annual basis might be achievable. So once you do figure out your income, you want to combine it together with your Social Security, I suppose, once you hit 65. But for those who want to retire earlier, you can probably figure that out yourself. But of course, there are some flaws for income investing. For example, for income investing, you can't touch the principal. So whatever amount of money that you put into your brokerage account or towards your home, perhaps you paid off your mortgage. From that perspective, you'll be house rich but cash poor. And if there's any emergencies, like major emergencies, like medical bills, you won't have the ability to really tap into your principal without really damaging your income investing. If you planned out having an emergency fund, then this wouldn't be an issue at all. So you want to keep some reserves there, maybe in a checkings account or a money market account, probably in an account that's hard to tap into because there's no point in having an emergency fund if it's easily accessible. But for this strategy to work, you definitely have to have excess funds at each of the end of the month so you can reinvest it and further grow your asset net worth. But a lot of the strategies that the FIRE movement uses, financially independent, retire early individuals, they would have 1/3 in dividend paying stocks, 1/3 in bonds, and 1/3 in real estate. So that's actually a very good balance that will give you a good income on a monthly basis, as well as security as well. The rest of the money that you have remaining, you can also invest into mutual funds or ETFs, or taking a little bit more risk by purchasing cryptocurrencies or high-risk stocks or growth stocks. You also want to look at the taxes as well. You definitely need to calculate that into your overall nest egg. For example, municipal bonds, there's zero taxes for that. And dividends, as an example, there are certain benefits that the government may give you as well for having dividends. So keep that in mind as well for looking at your taxes for your investments. But if you do decide to invest into bonds, there's a whole bunch of different choices for you. There's government bonds, there's agency bonds, there's savings bonds, and it keeps going on. But a lot of people find maybe bonds as a safer choice than investing into the stock market, but it's debatable, of course. But the thing with bonds is that the potential of gaining any profits from it is kind of small. For mutual funds, it only works if you get a consistent amount of interest on a daily basis, and but they are easier to manage. And there's also annuities as well, fixed deferred annuities, where it's guaranteed principal and interest. So sometimes people prefer to choose this instead of mutual funds. But there's dividend paying stocks as well that both of us heavily invest into. The reason being is because we get to manage the account ourselves by choosing the individual companies with their separate dividend yields. So we always pick the leaders in the industries, and we have been investing for the last 15-year period into dividends. But it does take a little bit of sit down in doing some research, your own due diligence on those individual stocks. And the reason why that I really like dividends is because it actually has a larger return compared to mutual funds or annuities or ETFs. And also companies are known, if you look at the historical data, to increase their dividend yields on an annual basis. And there's some companies that have been giving out dividends for the last 100 years. So you can see from that perspective that a lot of those companies are quite stable. And finally, I would probably invest into real estate, which we do. And we actually paid off the mortgage off of a rental property. So we're just getting a residual income there, 100% into our pockets. But it's easy to manage as well. We have a property manager that manages all of the maintenance. But keep in mind that there is a danger when you do invest strictly into one asset class, like 100% into real estate, or 100% into dividends, or 100% into annuities, etc. You want to be able to have a balanced portfolio of all of those different asset classes, so each one of them counterbalance. If in the event that one asset class falls, then chances are just kind of a seesaw effect where other assets tend to rise if one asset class falls. But you also never want to forget about inflation as well. You want to keep at, well, a lot of the central banks in the world try to keep it at a 2% rate. Sometimes it falls below this or sometimes above this, but then there's different ways to calculate out the inflation metric. But you want to keep that in mind in the longer term, to always try to be ahead of inflation, so your investments grow above it. So all of those asset classes that I have mentioned are relatively, historically have always been above inflation. But if you have gone this far into my vlog, you're probably a very conservative investor, and you can probably do some of the research yourself to figure out whether or not any of the asset classes that I have mentioned could be added to your existing portfolio, to see whether or not you can continue growing your income source, perhaps towards financial independence later in the future. But for those that don't have an investor's portfolio or are just starting, maybe you can consider some of the points that I mentioned here in this vlog today, and see whether or not you can apply them. And there is that possibility in the future for you to gain all of this income that you generate yourself. And I'm proof of that, or we are proof of that. And we definitely have all of those asset classes that I mentioned today, and it keeps growing exponentially year after year. And this is actually my third year of being financially independent and self-sufficient without a traditional job. So you can start figuring that out now, so you can move towards your freedom in the future. Well, tell me what you think of living off of investment income in the comment section below. If you like this vlog, please don't forget to give me a like, subscribe if you haven't already, and hit that notification bell for more of my coming content here. Thank you for watching my vlog. I hope you have a great day, and see you soon.